Hey everyone, welcome back. When it comes to the world of finance, there are a few names that command as much attention as Stephen Cohen.
Oh, absolutely. The guy's a legend, right? Make billions, built an empire.
Exactly. And today, we're taking a deep dive into his world, specifically his trading strategies. We're not going to become Stephen Cohen overnight, obviously.
Haha, no.
But even if you're not a Wall Street titan, there's so much we can learn from how he operates. Because at the end of the day, understanding his approach helps us understand how markets work, how information flows, how decisions are made.
Yeah, you hit the nail on the head. It's like peeking behind the curtain.
All right, so Cohen is known for his aggressive style. He goes after what are called fleeting market inefficiencies. What exactly does that mean?
Well, imagine the stock market as this massive ocean, right? And there are these like little ripples, tiny waves that appear and disappear in an instant.
Okay, I can see that.
Those are the inefficiencies. Most investors, they're looking at the big waves, the overall trends. Cohen, he's got his eye on those ripples.
So he's not just reacting faster. He's seeing things that others aren't even noticing.
Precisely. He's using this incredible network of contacts, teams of analysts, sophisticated algorithms, to spot these tiny mispricings that might only last for minutes.
Wow. So how does he actually capitalize on that?
Well, that's where his long-short equity strategy comes into play.
Ah, yes. Long-short equity. I feel like I hear that term thrown around a lot, but to be honest, I'm not always sure what it means.
Okay, sure. So the long part is pretty straightforward. You buy a stock you believe is going to go up in value. Simple enough.
Right. Buy low, sell high.
Exactly. But with short selling, you're essentially betting against a stock. You borrow shares of a company you believe is overvalued, sell them immediately, and then hope to buy them back later at a lower price when you have to return them to the lender.
So you're profiting from the decline. That sounds kind of risky.
It can be, yeah.
Oh.
But it also allows Cohen to make money whether the market is going up or down. If he's bullish on a stock, he buys it. If he's bearish, he shorts it.
So he's playing both sides. Interesting.
Right. And it's all about dup research. It's not just gambling. It's informed speculation.
Got it. So that's long-short equity. But his firm, Point72, also uses a multi-strategy approach. What does that mean? Are they just throwing everything at the wall and seeing what sticks?
Not quite. It means they're not limited to just one way of doing things. They're using all sorts of tools, from macro trading, looking at the big economic picture, to quantitative analysis, crunching massive amounts of data to find patterns. And of course, they've got teams doing deep fundamental research on individual companies.
Okay, so it's like a diverse toolbox. But here's the thing that really fascinates me. Even within that diversity, they also believe in specialization, right?
Absolutely. Cohen is a big believer in having teams that are laser focused on specific sectors of the market. Like, you'll have a team that lives and breathes technology stocks, another that's all about healthcare, another that knows energy inside and out.
I see.
They become experts in their niche. It's about going deep, not wide, at least when it comes to those specific sectors.
Yeah, because the more you understand a particular industry, the more likely you are to spot those little details, those hidden gems that others might miss.
Exactly. And it all ties back to that idea of uncovering those fleeting inefficiencies. You have to know where to look and what to look for.
Right. Okay, this is where it gets really complex, at least for me. High-frequency trading, or HFT. How does Cohen use this, and why is it such a big deal?
Well, think of HFT like having a super fast trading robot. We're talking about executing thousands, even millions of trades per second based on algorithms that are reacting to tiny price changes in the blink of an eye.
Oh,
It's a whole other level of speed and complexity, and it allows firms like Cohen's to capitalize on those fleeting inefficiencies we talked about. Of course, HFT is controversial. Some argue that it gives an unfair advantage to big players, that it can destabilize markets.
right, I've heard those arguments.
But it's a force that's sure to stay, and understanding it gives you a glimpse into how technology is shaping the future of finance.
Absolutely. Okay, we talked a lot about Cohen's aggressive moves, but let's be real. There's a lot of risk involved. How does he manage that?
Risk management is absolutely central to his approach. There are three core principles at play. First, strict risk limits. Every single trade has a predetermined limit on how much they're willing to lose. It's about protecting their capital.
So they're not betting the SARM on any one trade.
Nope. Second, diversification. They spread their investments across a wide range of assets and sectors. It's like the old saying, don't put all your eggs in one basket.
Makes sense.
And third, constant monitoring. They have a dedicated team that's constantly watching their positions, watching the market, ready to adjust their strategies as needed.
So it's dynamic, not static. They're always adapting.
Exactly. And those principles, they're valuable even outside of Wall Street, Whether it's managing your own personal finances or just making big decisions in life, understanding and mitigating risk is crucial.
Couldn't agree more. Okay, one last thing I want to touch on, information. Cohen is known for having this massive network of contacts. Why is that so important in the world of finance?
Because information is power. In the financial markets, knowing something even a few minutes before everyone else can make a huge difference. And Cohen's network is vast. We're talking analysts, industry insiders, even competitors.
So he's got his finger on the pulse.
Absolutely. He's constantly gathering information, connecting the dots, trying to anticipate what's going to happen next.
It's like having eyes and ears everywhere.
Yeah.
And speaking of understanding how people think, he also utilizes something called behavioral finance. What is that?
So, behavioral finance is all about recognizing how human emotions, fear, greed, hope influence investment decisions, and often those emotions lead to irrational behavior in the market. Cohen understands this, so he's not only looking for opportunities created by these emotional swings, but he's also very aware of his own biases, working hard to avoid those same emotional traps. It's about staying rational, disciplined, even when everyone else is panicking or getting caught up in the hype.
So to sum it all up, we're talking about a guy who's incredibly aggressive, but also incredibly calculated. He uses technology, information, and psychology to his advantage. It's really fascinating stuff.
Yeah, it really is. And look, I get it. Cohen's style isn't for everyone. But understanding how he operates, the strategies he uses, the risks he takes, it gives you a whole new level of insight into the inner workings of the financial world.
Definitely. It makes you think about how markets really work, about the role of information, and the importance of staying ahead of the curve. So what about you all listening? What aspect of Cohen's strategy surprised you the most? Head over to our social media and let us know. We'd love to hear your thoughts. Until next time.